eDreams ODIGEO is the world's leading travel subscription platform, driving recurring revenue growth through its Prime model. We're pleased to welcome David Elizaga, CFO and Board Director of eDreams ODIGEO, to present the full year 2025 financial results, highlighting performance, cash generation, subscriber growth, and the strategic priorities shaping the company's next phase of expansion. David, the stage is yours.
Hello, everyone. I'm David Elizaga, CFO at eDreams ODIGEO, and I will take you through our Q3 fiscal year 2026 results presentation for the 9 months ending 31st of December 2025. We are firmly on track to deliver on our new guidance. In the first 9 months, adjusted EBITDA increased 74% year-on-year to 138.4 million euros. Adjusted EBITDA isolates operational performance from cash timing effects of the move from annual subscription to annual with monthly installments. So this 74% increase of adjusted EBITDA shows the strength of the underlying business absent the cash timing effect. In terms of the Prime membership, we reached 7.7 million at the end of December. That's up 13% year-on-year. And as of the end of January, we hit 7.8 million subscribers, and we reaffirm our fiscal 26 target of 7.9 million members. Cash EBITDA improved by 2% to 126.7 million euros compared to the 9 months of fiscal 25, which was partially impacted by the investments we are making in new businesses, the temporary instability in our Ryanair content, and the timing impact of the move from annual subscription to annual with monthly installments. Despite this, growth resulted in a substantial expansion of our profit margins and is also on track to meet our fiscal 26 target of 155 million euros of cash EBITDA. In terms of the revenue mix, Prime-related revenue now accounts for 75% of cash revenue margin and grew 7% year-on-year. I will cover this in my closing remarks, but it is important to briefly highlight that our strategy review update back in November of 25 was done from a position of strength and is a high conviction move based on solid data from extensive test operations. All in all, we will deliver a much better business, faster growing, more profitable, and more diversified, and we are significantly undervalued. Moreover, we are committed to shareholder returns, and a proof of it is that we've repurchased 23 million euros in shares in the quarter that just finished, with 100 million in total committed through September 2027. We have already amortized 12 million shares that represent 9.4% of the share capital. And at the prices of yesterday, 24% share of eDO market capitalization is pending to be repurchased between January 26 and September 27, representing a yield to our shareholders of around 24%. And very few companies out there are doing this thing. Looking at the 9-month P&L, our cash EBITDA reached 126.7 million euros. That's a 2% increase. This was achieved despite headwinds, including the investments in new products, temporary instability in Ryanair content, and the timing impact of moving to annual subscription with monthly installments. Notably, our cash marginal profit margin expanded by 5 percentage points to 42%. Looking at Prime's impact on profitability and the drivers behind that growth, our cash marginal profit, which is a key measure of profitability, grew by 3%, reaching 207.8 million euros. This shows that our business is not just growing, but each transaction is becoming more profitable. This improvement is due to the maturity of our Prime member base. As members stay with us longer, their profitability grows, which is evident in the 7% increase in cash marginal profit for Prime, and its margin increasing by 4 percentage points over the past year. This is having a positive ripple effect on our entire business, as our overall cash EBITDA margin improved by 3 percentage points, from 23% in the 9 months of fiscal 25 to 26% in the 9 months of fiscal 26. Cash EBITDA for the 9 months reached 126.7 million euros, marking a 2% year-on-year increase. Adjusted EBITDA, which isolates operational performance from cash timing effects of the move from annual subscription to annual with monthly installments, increased 74% to 138.4 million euros. Looking at revenue performance, in the 9 months of fiscal 26, we have observed a few key changes in our revenue margin. Cash revenue margin for Prime decreased by 1% versus the 9 months of fiscal 25. While member growth was a positive factor, it was offset by an enlarged test in the first quarter of fiscal 26 and the move from the second quarter of fiscal 26 to the annual with monthly installment subscription fees and the progressive implementation of this option in the current quarter. Now I will take you through some of our closing remarks. Let me start by reiterating that our strategy review update back in November 25 was done from a position of strength and is a high conviction move based on solid data from having tested the new products over 1 to 2 years. First, we are accelerating the growth and profile of the business. We expect record net adds of 1.5 million to 2 million per year between fiscal 28 and fiscal 30. These are growth rates of 15 to 20% per annum, which is a much higher growth profile than the trajectory we were on. Second, we have a de-risked business model. The new guidance is built on conservative, high certainty foundations. We have built a new guidance, lowering expectations for Ryanair content and pivoting to an annual commitment with monthly installments subscription fees. And third, this is a team that delivers. It is not the first time we have announced a long-term plan, and each time we have met our 3-year guidance. We did this in the cycle from 2017 to 2019, and again in the cycle from 2021 to 2025. All in all, while we face a temporary timing impact on cash metrics as we move to annual subscription with monthly installments, this shift allows us to capture a much larger market share and higher quality and more diversified revenue streams. And we're still guaranteed to get this money from customers. It is merely a timing difference in recognition of the money. We are setting ambitious but realistic targets. Those targets are clear: 30 million plus members and 270 million plus in cash EBITDA by fiscal year 30. Our growth trajectory will deliver record net adds of 1.5 to 2 million members per year between fiscal 28 and fiscal 30. Cash EBITDA margins will dip to roughly 15% in fiscal 27 during the peak investment phase, and will return to 23% by fiscal year 30 as these new members mature. And to be very clear, the anticipated decline in EBITDA margin over the next few years is solely due to expansion into new products and geographies as a result of the initial investment to support the company's future growth. You saw this in fiscal 22 to fiscal 25, and you will see this again in the coming years. We have done this before. eDO has a team that delivers. It is not the first time we have announced a long-term plan, and each time we have met our 3-year guidance. We have clearly demonstrated our ability to deliver on a long-term plan, such as the very aggressive targets we put in November 21 for March of 25. That strategic shift involved significantly more risk than this latest one, and yet we still delivered, despite headwinds like Omicron, the wars in Ukraine and the Middle East, double-digit inflation, and a consumer confidence below pre-pandemic levels. So the market should have no doubt that we will again meet or exceed all our long-term plan targets. Furthermore, the current strategy is more conservative and designed to ensure future growth, building upon the existing solid foundation. We believe there is a significant disconnect between our performance and our valuation. In terms of implied multiples at current prices, we are trading at between 4.4 and 4 times fiscal 26 cash EBITDA and adjusted EBITDA. The opportunity is that if we apply the average multiples of other OTAs or B2C subscription companies, which trade in between 8.3 and 11 times respectively, there is massive upside potential as we hit the lowest point of our investment plan in fiscal 27 and accelerate thereafter. We think it is important to highlight that we're not alone. Other successful subscription companies like Netflix broadened their business model, causing a share price decline, and the share price re-rated as a company executed on their plan. In summary, we're delivering a much better business, and we believe we are significantly undervalued. We are achieving higher growth with a 15 to 20% Prime member CAGR from fiscal 27 to fiscal 30. We are seeing higher customer lifetime value and a stronger loyalty, with a 10% increase in net promoter scores. By fiscal year 30, 66% of our volume will be diversified away from the core European flight market. We're inviting you to join us as we believe the current share price is significantly undervalued as we execute this final stage of becoming the world's preeminent travel subscription platform. The market is currently using conservative assumptions and high discount rates. Analysts are valuing us at an implied 6.4 times EV to cash EBITDA, well below the 8.3 and the 11 times average for global OTAs and B2C subscription business. The one-time cash unwind is planned, but we're still guaranteed to get the cash. The growth will accelerate, and the valuation gap represents a massive upside for investors who recognize the strength of the world's leading travel subscription platform. I will reiterate once again that this is a high conviction move based on solid data from extensive periods of time of running this business and not a defensive move. It was a change to a high growth strategy done from a position of strength. And I will conclude by saying that we will continue the share buyback as we are committed to shareholder returns. A proof of it is that we have repurchased 23 million euros in shares this quarter, with 100 million committed in the period from October 25 to September 27. We have already amortized 12 million shares, that's 9.4% of the share capital, and at yesterday's share price, 24% of the market capitalization of eDreams is pending to be repurchased between January 26 and September 27, representing a very high yield to our shareholders. There are very few companies out there doing the same. This concludes my closing remarks. Thank you very much.
Thank you, David, for the comprehensive overview of eDreams ODIGEO's full year 2025 performance and strategic progress. For investors seeking further insights into the company's growth trajectory and subscription strategy, visit Seat 11A to explore additional presentations and updates. We look forward to sharing more developments from eDreams ODIGEO soon.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.